The airline sector just outperformed the S&P by nearly 4 to 1, 39% versus 14 over the last 3 months. But 9 airlines reported very different stories inside that number. Some are printing record margins, 3 are still losing money, and the street is quietly downgrading names that doubled. We pulled the data on all 9 carriers. Here's what it says heading into Q2 earnings. The airline sector is up 23% year to date. That's more than doubling the S&P's 10% return. Heading into Q2 earnings, the setup is constructive. Travel demand remains robust. Fuel costs are declining with crude down 20% in June, and fare increases are holding. But not all airlines are created equal. The data separates the sector into 4 tiers. Tier 1 in Delta. These are the institutional favorites, 27 to 28 analysts each, with near unanimous buy ratings of 1.2. Price targets have climbed 15 to 25% over the last 90 days. Q2 consensus earnings, $1.87 for United, $1.57 for Delta. Both profitable, both generating strong EBITDA, and both expected to guide Q3 ahead of consensus. Tier 2. Allegiant and SkyWest, both profitable with strong buy ratings below 1.45. Allegiant's rating has improved the most of any carrier over the past 90 days, moving from 1.59 down to 1.35. SkyWest has the highest earnings in the sector, $2.53 for Q2 and $10.83 for the full year. Tier 3. American and Southwest, mixed ratings between 1.66 and 1.77, both profitable, but barely. American's Q2 consensus is just 3 cents. Southwest is at 51 cents. The street is cautious here. American's rating has actually weakened over 90 days. Tier 4. JetBlue and Frontier, ratings above 2.0. That's as bearish as Wall Street gets publicly. Both are losing money. JetBlue at negative 69 cents, Frontier at negative 47 cents for Q2. Full year estimates show JetBlue losing $2.32 per share. These are the weakest carriers in the sector. Now here's the surprise to watch. Frontier is up 117% in 3 months with the worst fundamentals in the group. A 2.21 rating from 12 analysts on a money-losing carrier that has more than doubled. That's speculative momentum, not institutional conviction. If Q2 misses, that unwinds fast. 3 things to watch as earnings approach. First, Q3 revenue guidance. If carriers guide above consensus with accelerated revenue per seat mile, the rally extends. Second, capacity discipline in the second half. Elevated Q4 capacity expectations may need to be revised lower. Third, fuel cost pass-through. With crude down 20%, the question is how much flows to margins versus fare. So if you're looking at airlines right now, here's how we'd frame it. United at 154, with a consensus target of 155. That's fully priced for the beat. The upside is in the guide. Delta at 101, with a target of 101. Same story. Both need Q3 guidance above consensus to move higher from here. The asymmetric setup is Allegiant. Target 134, rating improving fastest in the sector. Profitable, and still 28% below where the street sees it. If Q2 delivers, Allegiant has the most room to run. The asymmetric risk is Frontier, up 117% in 3 months, while losing money, with the worst rating in the group. That's the short if earnings disappoint. Airlines up 39% in 3 months. The data says the setup is favorable, but the opportunities are not equal. Choose your carrier carefully. This is Alphatica. We track the data.